Welcome to The Explainer. Did you know we're talking about trillions, literally trillions of dollars in global corporate assets that are at risk of becoming entirely stranded over the next decade? For the longest time, sustainability was treated as this side project. It was something handled by PR to make a company look good on a brochure. But those days, they are completely over. Today, sustainability is a core financial metric. It's about survival, it's about risk, and it's about the fundamental value of a business. So we're going to look at the exact blueprint companies are using right now to prove their financial resilience to the world.
But that brings us to a very direct question. How do companies actually report this stuff? I mean, we hear all these big promises about going green or hitting net zero, but how does an investor, or a regulator for that matter, know what's real and what's just noise? We really need to step away from the abstract ideas and look at the practical, standardized framework that is fundamentally rewiring how businesses operate.
And enter IFRS S1 and S2. These are essentially the ultimate solutions to that reporting problem. Developed by the International Sustainability Standards Board, these standards explicitly require companies to disclose how sustainability and climate-related risks and opportunities affect their financial prospects. This isn't just about saving the planet. It is absolutely crucial for connecting environmental and social realities directly to a company's financial statements, their cash flows, and their cost of capital.
To pull this off, IFRS S1 and S2 are built on a highly structured architectural blueprint. It's made up of 4 core pillars. Pillar 1, governance. Pillar 2, strategy. Pillar 3, risk management. And Pillar 4, metrics and targets.
Okay, let's dive right into this. Section 1. Pillar 1, governance. Who is in the room making decisions?
Before we even look at a single data point or carbon footprint, we have to establish accountability. Who is actually in charge? Let's contrast the two major players here. On one side, you've got the board of directors. Their job is that high-level oversight. They oversee the strategy, make sure the right skills are in the room, and, this is a big one, they decide if executive pay is actually linked to hitting these targets. Then on the other side, you have management. They're in the trenches. They execute the day-to-day controls, monitor the risks, and integrate these procedures into the daily corporate grind. Both have very distinct, mandated roles that have to be clearly disclosed.
To bring this theory to life, let's look at a case study from our sources. Mega Textiles Ltd. Their board decided that, just overseeing things wasn't enough. To really lock down governance, they linked a portion of executive remuneration directly to achieving formal ESG targets: environmental, social, and governance. They also required regular internal audits of their sustainability practices. This is exactly what true governance looks like under IFRS S1. It ensures hitting these targets isn't just a nice-to-have corporate goal, it directly impacts leadership's paychecks.
That leads us perfectly into Section 2. Pillar 2, strategy. Stress testing the business model for the future.
This is where companies have to figure out how sustainability actually impacts their long-term financial planning. Under IFRS S2, they use scenario analysis to stress test their strategic resilience against different futures. Step 1 is the low-carbon transition scenario, basically what happens to the business if the global economy rapidly shifts to a well below 2 degrees Celsius pathway. Step 2 is the business-as-usual scenario. What if the world keeps polluting like it is, resulting in severe physical risks, extreme floods, heat waves, supply chain nightmares? Companies have to disclose exactly how they'd financially navigate both of those realities.
And this brilliantly illustrates transition risk in action. Check out this breakdown for AutoCo, a major global automaker, from our source materials. Right now, a massive 80% of their revenue comes from internal combustion engine, or ICE, vehicles. Just 20% is electric or other. If the world aggressively shifts to EVs under that low-carbon scenario we just talked about, AutoCo faces a terrifying financial threat: asset stranding. Their massive production plants, which are totally optimized for gas-powered cars, could suddenly become completely obsolete.
So how does their strategy adapt? AutoCo can't just write a glossy sustainability report anymore. They have to disclose real strategic responses. That means showing how they are reallocating R&D spending away from gas engines, establishing entirely new business units for green transport, and actively managing the financial hit, the impairment, of those legacy assets. The strategy pillar essentially forces companies to prove they are actively shifting capital to survive.
Once you've identified those strategic risks, you need a systematic way to handle them. Section 3, Pillar 3, risk management, spotting the cracks before they break the foundation. To do this, companies are required to follow a really standardized 4-step process. First, identify. You have to find those sustainability risks using hard data inputs. Second, assess. Determine the likelihood and the magnitude of those risks. How bad could it get? Third, prioritize. Rank these alongside all your other major business threats. And finally, integrate. This is key. You must embed this monitoring seamlessly into the company's overall enterprise risk management system. It absolutely cannot be kept in a silo. The Himalaya Mines case study is a perfect example of this integration. They operate copper and cobalt mines, and they were facing serious allegations of water pollution and local community disputes over a lack of jobs. Under IFRS S1, these aren't just, local PR headaches. They are material risks that literally threaten Himalaya Mines' social license to operate. To comply, they have to formalize risk identification and integrate those specific social and environmental risks right into their overarching enterprise risk framework.
All right, now we arrive at the final phase, Section 4, Pillar 4, Metrics and Targets, measuring the build and tracking progress.
You've governed, strategized, and assessed the risks. Now, you have to prove it with hard data. Let's decode the technical jargon of greenhouse gas emissions under IFRS S2, because companies have to report across 3 distinct scopes. Scope 1 covers direct emissions. Think of the smoke coming out of Autoco's own manufacturing plants. Scope 2 is indirect emissions from purchased energy, like the electricity Megatextiles buys to run its factories. But Scope 3, that's the giant. It's the indirect emissions across the entire value chain. For Autoco, that means the emissions from their supply chain logistics, and massively, the emissions from consumers actually driving their gas-powered cars. It ensures the total impact is on the table.
But here's the thing, just reporting a number today isn't enough. Companies have to set clear, verifiable timelines. They establish a base period as their starting line, then they track performance over interim years, say years 1 through 3, and analyze trends in years 4 and 5, explaining any adjustments along the way. Finally, they measure against a final target year. This creates a highly structured, transparent timeline that investors can actually trust. It's a real roadmap, not just a snapshot. Which brings us to this critical number, 2035. This is the year Autoco faces potential regulatory bans on ICE vehicles in key global markets. Suddenly, those 4 pillars we just went through, governance, strategy, risk management, metrics, and targets, they aren't just some reporting exercise. They are tied directly to this ultimate deadline. By 2035, Autoco's capital reallocation, their transition to EVs, and their very survival as a company will be put to the test.
And that brings us to the core takeaway of everything we've looked at today. Under IFRS S1 and S2, sustainability reporting is no longer a separate exercise. It is about the faithful representation of matters that directly affect an entity's cash flows, its access to finance, and its cost of capital. That ESG data, it now fundamentally drives financial resilience and investor decision-making.
So I want to leave you with this final thought to consider. As the global economy aggressively transitions, will your company's assets become stranded? Or will you use this exact blueprint to build a resilient, future-proof business? The framework is out there, the standards are firmly set, and the financial markets are watching very closely. Thank you so much for joining me on this explainer. Keep learning, and I'll see you next time.